Well, good morning, everyone. It's Michael Lee, and welcome to the weekly shot, no filter. This is your Better Homes and Gardens Real Estate Mason-McDuffie weekly webinar. Today, we're going to be talking about new lending rules that can give you more buyers. This is going to be a fascinating program, and I think you're going to be able to help some of your clients in more ways than you might have imagined. Today we have with us Ed Jeffrey. He's Vice President of Business Development and Strategic Alliances for Better Homes and Gardens Real Estate Mason-McDuffie. Ed is a lifelong resident of the Bay Area except for 4 years when he was attending college at Fresno State University.
Go Dogs.
He grew up in a family that was very involved in real estate, and Ed decided to major in both real estate and finance at Fresno. As circumstances would have it, he felt that mortgage lending, he would go into mortgage lending immediately after graduating. Throughout his career, Ed has been a mortgage broker, a mortgage banker, and worked for major banks. In 2006, Ed was awarded Loan Officer of the Year from an international lending organization. Ed achieved this prestigious honor through his work with homeowners and home buyers in bankruptcy. That's a great market there, Ed. It was through this work with buyers with credit challenges that Ed was introduced to his next niche, which was mortgage lending, which involved athletes and entertainers. I want to hear more about that.
Sure.
And Ed's experience there led him into leadership with his company, and he has been involved in management or ownership since that time. As many of you may recall, Ed came to us through our affiliation with Citibank and recently made the move over to our other lending affiliates, Land Home Financial Services. It is the vice president. He is the vice president of business development for strategic alliances with Land Home as well. Welcome, Ed.
Thank you very much.
So, Ed, let's make sure your microphone is on here. How's that?
Better, maybe?
Yep. Very good.
Okay.
So I do want to remind our audience to type in any questions that you may have into the question box on the right-hand side of your screen. So, Ed, let's start into the program here.
Okay.
As we already talked about, you're responsible for both Citibank and Land Home Financial's relationship with Better Homes and Gardens. And so let's talk about what's going on with pre-approval, why people don't qualify in underwriting, maybe some things to know when you write a contract, credit issues, and let's talk about some other things as well. So let's just really briefly talk about pre-approval.
Okay.
What does an agent need to know to get their client pre-approved, and why is that a big deal, or is it a big deal?
Well, from my point of view, I think it's a big deal simply because there's different types of pre-approvals, and I'll say that with quotation marks around it, that you as a realtor will receive. You'll get things that are just on a simple sheet of paper that say something as basic as this person's pre-qualified. You'll have others that'll say that someone has been pre-approved, and yet maybe others that actually read words that say that this person we're going to commit to lend money to this person.
So is there a difference?
There are differences, dramatic differences between the three. And it's really kind of a matter of confidence. Basically, those words can tell you as much or as little as you can read into them, and it's really a question as a realtor. You should be asking that lender to provide you with additional information. Has this person already been approved? And that means that they've gone through the underwriting process, and an underwriter has looked at their financials and given their authority, they're the ones with the power of the pen, the authority to go ahead and will lend money to this person. The opposite could be true, where we are simply, as mortgage lenders, looking at their basic financials, a paycheck stub, a W-2, for instance, and their credit report to determine whether or not they may qualify for lending.
So is that more of a pre-qualification letter?
Exactly.
And so you're saying that the pre-approval letter is stronger?
It is stronger. It will definitely give additional weight to an offer. when a listing agent, supposing that they understand the difference as well, or at least that difference has been communicated to them by a mortgage banker or mortgage lender. That's something that I would definitely recommend, is that you have your loan officer make a phone call for you when you're presenting an offer in order to alleviate some of the fears or some of the questions that that listing agent may have, just to know that, in fact, this is a bona fide offer by a pre-approved borrower.
So you're recommending, whether you're in multiple offer situation or not, that you have a lender call the listing agent just to kind of verify the qualification of the buyer. And it would sound like this is even more important in multiple offer situations.
Most definitely in multiple offer situation. I think it's something that should be done by your mortgage lender, by your affiliate mortgage lender. If in fact it's not done, the offer letter is going to be received, or your offer is going to be received, hopefully with our pre-qualification or pre-approval in it, so that the listing agent knows that that person is in fact pre-qualified or pre-approved. I just think it's a really good way to start a relationship. It will indeed help solidify an offer. You can personalize it as a mortgage lender, calling up a listing agent and saying, "Hi, my name is, I'm just letting you know that this borrower has already been pre-approved. I've worked before with this realtor. I'm very familiar with how they do business. I can tell you, just a simple little endorsement."
Sounds very reassuring to a listing agent.
Indeed.
All right, just give us a couple, let's say 2 or 3 things that would really cause a client to be declined.
In general, income is always a major issue, credit being the second most important issue, but income right now is underwritten with a very, very unique eye. Very specific information is looked at in much more detail than it was just a few years ago. So it's really important that a buyer presents their financials to that person, that mortgage lender, that trusted person who you are working with, and that information is analyzed to a degree that's a little bit more significant than it was before. I mean, we could basically ask a question once upon a time, "Hey, how much do you earn?" "Oh, you earn that amount. Okay, so we can ballpark that you can qualify for this dollar amount." That was then. This is now, where even a few dollars of overtime are analyzed, or if somebody has shift work or bonuses. I mean, everything is looked at.
It's very different these days than 10 years ago or even 5 years ago.
Indeed, absolutely. So it's critically important that someone will tell you, they'll answer a question as simple as, "Oh, how much do you earn?" And they'll let us know, but they're taking into consideration their overtime or their bonus checks or any other number of different sources that could come into play to help them qualify. But yet, in fact, we may or may not be able to use that information based on whether or not we can provide evidence of its continuing, or whether or not it's been going on for a period of time in the past as well. So it's difficult.
Okay. Have there been any changes in FHA, VA, and conventional lending recently that our agents need to know about?
Well, I think the primary things that you want to be aware of is that all of those things that you just mentioned, basically any kind of financing that when you're qualifying to buy a home, are constantly changing, which is really the challenge in my industry.
So what is a realtor to do, though, Ed?
Well, I mean, honestly, I think the best thing that you can do is develop a relationship with a mortgage lender who, in fact, knows what they're talking about.
Because they're the experts. We're not.
Indeed, indeed. I mean, I don't profess to know everything there is to know about writing offers or receiving them, or even, for that matter, reading every little detail about the contract. I don't want to, quite honestly. However, I should know all the ins and outs of what it requires to get a mortgage loan on a property, because that's my field.
Okay. And so the good news is we don't have to be the experts on lending.
Absolutely. I would recommend you don't try to become an expert in lending. It will keep you from selling property.
Yeah, probably keep us real busy. So we talked about some of the reasons that people might be declined. Anything else you want to say about these thoughts here?
Let's see. So if we're talking in particular temporary income can be something as simple as you won a lawsuit and they're paying you out over time. But that period of time may not be a very long period of time. It might be something that's you were hurt in an accident and they're paying you over
maybe
whatever.
a year.
Right.
Mm-hmm.
So that would be something that maybe someone would normally consider that they could use to help qualify for a home loan.
Apparently not.
But that is not so. That is not so. So things like the continuity of the length of time that we're going to receive, that an individual is going to receive that income, that comes into play. Undisclosed debts are things that you're going to find on a person's tax returns. If someone's paying back the IRS over time rather than making a lump sum payment, that's a debt that won't show up on a credit report, and it's generally not disclosed when we're taking an application because they just automatically assume, well, okay, well, I have this $250 payment that I make to the IRS every month, but whatever. It shouldn't come into play right now.
Yeah, I don't need to disclose that.
Right, but and you wouldn't think as a borrower of money, you don't necessarily think that, oh yeah, well that's just automatically taken out of my paycheck or it's taken out of whatever, out of my bank account once a month automatically. It doesn't show up as a debt that I owe, so therefore, why do I need to tell anybody about it?
Okay.
So those are things that we find in the analysis portion of whether or not someone is going to actually qualify to buy a home or not.
Okay.
The reason I think this stuff is important, honestly, Michael, is you as a realtor want to know, is this person worth my time to put in my car and drive around, the county looking at property? If you're going to spend that kind of time with someone, you want to know that that person has been approved or they are capable, they have the capacity to follow through on borrowing enough money to buy the house that you're showing them.
Yeah, because otherwise, why would you waste your time?
Right, exactly. I mean,
and yet people do.
Oh, well, I'm sure that they do. I mean, it's an exciting time. Someone comes to you through a floor call or whatever means that you've generated. You've done some marketing. Blood, sweat, and tears have gone into getting that phone to ring. It finally rings, and you're excited. You want to throw them in your car and go. Well, let's make sure that we can help qualify them and allow them to purchase that home that you show them.
All right, we're skipping through a couple of these, and anybody who has questions obviously can get in touch with you or their lender.
Sure.
But I noticed this number 5, common reason for underwriting decline is too many past employers. That seems like it'd be a good thing.
Yeah, you would think. Somebody has worked their way up the ladder, and they've moved from Company A to Company B with a better job, and they're now at Company C with a third job.
Yeah.
What you would think, financially, that is a good thing, right?
Yeah, and if it shows constant progression, I think I'm great. You should look at my current job, my highest income. I'm good.
Yeah, absolutely. And you would,
but no?
As a lender, you would want to be able to, honestly. We want to give everybody as much credit as we possibly can, right? But there are challenges in doing so. Essentially, the situation could provide itself where that income is unjustifiable or it looks unjustifiable on paper. So someone went from, floor salesperson to managing the department to suddenly they're a vice president, all in a short period of time. There may be justifications for that, but an underwriter may choose to say, okay, well, this is such a short period of time and with multiple different companies, I'm going to average their income over a 2-year period of time rather than give them full credit for what they're doing.
But
right
Ed,
now.
they're making the higher salary currently.
Agreed.
Why would you go back and average those?
They're going to average it for basic reasoning is that they're looking, you have to understand, an underwriter is looking for not the reason to turn down the loan. They're looking for reasons to approve the loan, but they're also looking to make sure that that loan is a quote-unquote safe loan. It's something that we can invest our entire amounts of money in and know with some level of certainty that there's going to be a solid payment history with that borrower. So they're going to take risk, and this risk, and in order to limit that risk, they're going to look at it and say, okay, I'll give this guy credit, but I'm going to weight that credit a little bit more into the past than into the immediate future or into today's present tense.
Well, I like what you say, that lenders are looking to approve a loan, not to turn you down, although it sure doesn't seem like it.
I agree with you. I couldn't agree with you more. It feels the opposite way
a lot
of the time. A lot of the time. But from their point of view, I'll throw myself in there as well. From our point of view, you have to remember the amount of losses that those companies took and the various number of companies that no longer even exist because of their inability or what Greenspan called irrational exuberance. They got super excited about being able to lend money, and they were so happy to be able to do it all the time. And
they went crazy.
They did go a little crazy, right? So they got out of their own way and stopped doing what they were normally doing, and then it cost them a lot of, or us all, quite honestly, a lot of money, as well as an entire cycle of real estate kind of went sideways, right?
Yeah, that's too bad. Well,
Yeah.
we can understand some of it. The rest we'll just have to trust to faith. All right, now let's talk about some occupancy misrepresentation. I don't think a lot of our realtors know what a straw buyer is.
Right. Okay.
Can you give me the short story on that?
In short, you're buying a property that you're representing is going to be for yourself, but in fact is not for yourself. It's for someone other than you.
Maybe my brother who doesn't have very good credit.
Exactly. Or for a son or daughter who's coming here to go to school, and you're buying a property as an owner-occupant, when in fact that isn't what your intention is. You're staying wherever you live. You're just buying a second home or something to that effect.
Maybe even a rental property.
Could be very much a rental property, absolutely.
And most of us know that if you buy as a rental property, your rates will be probably higher.
Correct.
Your points will probably be higher.
Points could be, but essentially the rates are higher, and the amount of down payment is what really the big change is. So that's in essence. Obviously, it's not legal. We just.
I think they call it fraud against the lender.
Correct.
Right? And that's kind of a big problem, isn't it?
Indeed. Yeah.
Is that a federal crime?
Well, let's just say you'll have to relocate, and you'll get a very pretty orange suit to wear,
and 3 squares a day.
all of that fun. Exactly.
I don't know. Sometimes it sounds pretty good to me, Ed. I don't know.
Well, I mean, in essence, that's the thing. You just with your buyers, you want to make sure that you understand their intention, as do the people that are trying to help them buy that property. There probably is a different way to go about purchasing that property that may accomplish the same thing. They're hoping to buy that home for their son or daughter who's going to school, or they're hoping to buy that home for their in-law or whatever. Just to help them out, but their capacity is where the challenge is usually.
Right.
They don't have the down payment is really the number one reason, or they're looking for that lowest possible rate. We have to counsel those folks into the thing that they're suggesting could get them and us in a lot of trouble.
Okay.
Yeah.
And what about this one? Unreasonable commute?
Yeah.
You're kidding me. I could get turned down because I commute. What does it matter? I still put in an 8-hour day, a 10-hour day, whatever I'm contracted to do. What does the lender care how long it takes me to get to and from the place I'm buying?
Really, what this is it raises a red flag, and it's going to be the underwriter is going to look at this and say, okay, you're a sales manager and you live in Walnut Creek, and you now have a job in
San Francisco.
Well, San Francisco would be close enough, but say for instance
Santa Clara.
Santa Clara maybe.
Santa Clarita.
Really, where this would raise a big red flag is anything in excess of 50 miles. If you're commuting more than 50 miles to go to a job that you could essentially achieve in your local hometown or somewhere close to hometown.
So they're wondering, why are you going that, or at least say you're going that far?
Right, exactly. We have similar situations that happen in the education profession where you have a professor who lives in San Francisco, but their university is in Chico. Well, that's an unreasonable commute to go all the way to Chico to teach, when in fact you could probably get a position of similar capacity somewhere around where you are presently residing. So that would raise a red flag. That's an unreasonable commute.
Okay, that makes sense. Let's move along to another issue, and that would be credit. I guess we're pretty familiar with credit. Anything you want to say about being turned down because of credit issues? I think we're pretty familiar with credit. Anything unique here?
Well, I think one of the things...
And let's explain what BK is
indeed.
To some of our folks.
BK is just a lender term for bankruptcy. It's just we tend to abbreviate a lot of different things when it comes to us being able to communicate it in a more effective, more efficient manner. BK is bankruptcy, and that could be either a 13, a 7, even 11. 12 is for a farmer. All these kinds of weird different things that you find out being in my industry. Really where we find issues where a decline would come is because the proper amount of time hasn't elapsed, or there wasn't a sufficient explanation about a shorter period of time happening with one of these examples, either bankruptcy or foreclosure.
Now, we're going to get into in just a little bit some of the changes in these laws, because I think a lot of us assume that you've got to wait 7 years after having a bankruptcy or foreclosure
Indeed.
Before you could buy again, and this may not be the case. Is that correct?
Most definitely is not the case. And in fact, this was really where I found a niche within the mortgage lending world back in the early 2000s, was working with people who had had a bankruptcy or some sort of credit challenge. Now, they're really an unlooked at or an overlooked group of folks that basically are led to believe that, in fact, they do need to wait that 7-year period of time. It's not true. You can buy after you've had a bankruptcy with as short a period of time as 1 year.
Really?
Yeah.
1 year after bankruptcy?
1 year.
Because most of my clients they said, oh, well, we had a bankruptcy 2-3 years ago, and so when we get close to that 7-year period, we'll give you a call.
Right.
Could these be clients today?
They most definitely could be clients. In fact, there are programs that are available that will allow people to buy as soon as a day after they go bankrupt, which is a little bit absurd, but that's true. The time frames that I'm giving you are for actually conventional financing or FHA financing, like literal A-paper financing.
Wow.
So that's a big difference between what some folks would be led to believe, that they would have to borrow at 10% interest rates, have to have at least 20 to 30% down. Those things are not true as long as you're working with people that understand these rules and regulations and can help guide someone through that.
So the thing we want to do is to talk to our lender and don't make assumptions.
Indeed. And I was able to, when I was doing loans on a daily basis, you could purchase information from list companies about folks that have gone through a bankruptcy or a foreclosure or things to that effect. And technically you could, well, very much so, you could market to those people. And right now I'm assuming that what I'm hearing in the marketplace is that there aren't a whole lot of multiple offer situations anymore. In certain pockets there are.
It depends on where
Right.
you're at.
Exactly. So if you had some ready-made buyers in your pocket that were looking at property right now, they more than likely could make an offer and possibly get that offer accepted. At least the percentage of acceptance would go up.
Sure.
Okay.
Sure.
So if you had a few buyers that had actually had a bankruptcy or had gone through a foreclosure process, my feeling or my experience with those folks were they were incredibly loyal customers.
Of course, they're very appreciative.
Oh, most definitely. So if you could get that person on your side and have them in your clientele, the chances of them backing out of an offer situation, they're probably going to work through whatever the challenges are. And I've seen over just in the last month where inspections have thrown out purchases, where simple things that you would think would be easily negotiated have just killed deals altogether. These people are going to be much more sticky, quote unquote. They're going to hang around. They're going to endure a little bit, and they're going to close escrow. And you have never met a more thankful person in your life as someone at the closing table who you're handing the keys over to, who has gone through this kind of a situation and didn't think that they could ever get back into the housing market again.
I can certainly understand that. What about number 2? No reestablished good credit after bankruptcy or foreclosure.
Yeah.
I think a lot of people, after they have a bankruptcy or foreclosure, just throw up their hands and
Exactly.
and they figure, I'll never get credit again, or at least for 7 years.
Yep.
How soon after a bankruptcy or foreclosure could you begin to reestablish credit?
1 day after the settlement of that instance. So
1 day.
1 day. So you can get a credit card the day after your bankruptcy has been discharged. The same thing would be true after a foreclosure event. Quite honestly, most creditors aren't going to know when the foreclosure event took place. I'm talking about credit card issuers and such.
Right.
I'm not going to tell you that those are great deals. I mean, you're usually looking at a very small credit card of a limited line of credit of around $300.
High interest rate.
30% interest rates.
But it's credit.
But it is credit. And the importance of that is that a creditor is looking at your most recent past. That's what they're looking at. The last 24 months is most important. So if you have an event like this, like a bankruptcy or foreclosure, and you throw your hands up and you say, I'm never going to get another credit card in my life, that's might be the most wise thing to do financially, but in terms of establishing credit, it's not. You're going to be behind the 8 ball trying to reestablish an evidence that, in fact, you are a credible borrower again when you go to buy a house or buy a car, for that matter.
So as soon as you have one of these problems, bankruptcy or foreclosure, and it's finished and done, you should begin to reestablish credit as soon as possible.
You want to reestablish, and what I used to counsel my applicants was just get a small card. You can get them, at creditcards.com. Nothing special. I mean, seriously.
Okay.
All right.
Creditcards.com. All right.
But they'll issue you a credit, and all I would tell them to do is just use it for a tank of gas.
And pay it off.
Pay it off.
Don't pay 30% interest.
Exactly. You fill up your tank. You're going to do it with your debit card more than likely anyway, so fill it up with the credit card and then transfer the money immediately, and it's the same thing, and just essentially establishes some good payment history and that you are capable of actually maintaining debt.
Okay. I think we're pretty clear on a pattern of late payments after bankruptcy or foreclosure.
Indeed.
You're just continuing your image as not a good, trustworthy, and creditable person.
Indeed. It's a credit risk, basically. If you're missing payments after your bankruptcy or foreclosure.
Bad sign.
Yeah, maybe not buying a house is a wise thing.
Probably. All righty. Let's look at things to know when writing a contract. Let's see if there's anything here that we really need to talk about. What do you think? Know what the cash to close amount is. I think we generally do that as realtors. Sure. We try to figure out their closing costs and if a seller credit is necessary. So what you're saying here is if they're short on cash,
right,
we may want to have the seller give a credit, and of course there are limits on that, correct?
There are limits. I think the most important thing about this is just understanding your buyer. If your buyer is cash poor, if they have limited cash resources, then that really dictates the type of financing that we're going to be able to offer that person. There are programs that require a number of months of reserves. So in other words, you may need to have 3 months of reserves of your mortgage payment in the bank after you close escrow. Well, you may look at that person and say, well, they've got money left over after they go to buy, but we may look at that person and say that money isn't sufficient. So in other words, we would need to do a seller credit or have some sort of money that's being paid back to them throughout the course of the transaction or at close of escrow through credits or bonds or gifts from relatives or whatever, so that they will increase the amount of cash that's left over post-closing to enable them to borrow that particular type of money from that institution.
Of course, that makes sense.
Yeah.
I want to remind our viewers and listeners that if you have a question for Ed Jeffrey, just type it into the question box on the right-hand side of your screen. Obviously, we should know what program the buyer is utilizing and write the appropriate amount of time frames, the loan amounts, the contingencies, those kinds of things. Obviously, we should just talk to our lender about those.
A simple question would do. I mean, what the turn times are in typical underwrite right now. Can things be done more quickly? Do we need more time? What's necessary?
And always add a little cushion.
Oh my gosh.
And also, I noticed down at the bottom it says, be aware of possible required repairs. So we should make sure that those are taken care of as well.
Indeed.
Anything else here? Know the comparables and be aware if there could be an appraisal issue. If there is there anything we can do in advance? I mean, nowadays, you almost cannot talk to the appraiser.
It's very difficult. There's a number of layers in between speaking with an appraiser and anyone involved in the transaction. I recommend for sure that when the appraisal is ordered and you know what date and time that person is going to be out there to appraise the property, that you go. And
I've done that,
yeah,
and they've been appreciative.
Most definitely. You'll find, I mean, they're people. They're going to be in good moods. They're going to be in bad
Yep.
moods. So the bottom line is, I always found it important to show up and just recognize the person, be nice to them. I mean, if you just show up and you're nice to those folks, typically they're going to be in and out in record time. By the way, it's going to blow your mind if you haven't ever done this before.
Oh yeah, it's hard. They hardly look at the property.
Exactly. Exactly. But I always recommend my realtors show up with a few comps that they can deliver to them, because there may be things that are sold or impending sale
that they don't know about.
They don't know about.
Yeah.
Exactly.
And hopefully you're the market expert. You should know.
Absolutely. And you can speak specifically to them about that property, about the nuances of that property that make it worth what that sales price is.
Now, what is this? Check to see when the deed transferred. Which deed are we talking about? Because it says anything less than 90 days ago is a flipped property.
Okay. So
which deed?
The date of close of transaction from the previous close on that home. That
So when the current owner bought the property.
Correct. Exactly right. So there are rules in lending about flipped property. Most investors who are flippers, who are expert flippers, are going to flip in a less than 90-day period of time.
Well, otherwise they wouldn't flip it.
Right.
Yeah.
Exactly. There's holding costs and things to that effect that affect their bottom line, their return on their investment. They want to get in, make the repairs, get back on market, and beyond. So why that is important is that if you know that you're buying one, or your buyer is buying one of those types of properties, something that has been recently renovated, it's incredibly important to know when the close of escrow was from that previous transaction, the current borrower, the current owner, when they closed escrow, because the rules in buying for us, for establishing finance for that property, are different. For whether or not we can actually put a loan on a property that has been purchased less than 90 days ago and is now selling for a higher price. So we need to make sure that at least we're aware of them, because we have to target different programs for that.
All right, so different programs for different kinds of properties. I think that makes a great deal of sense.
Correct.
All righty, what about anything else as far as flipped properties are concerned? I think we're probably good here. Or if your buyer had a previous foreclosure short sale, what do you mean can be the catalyst?
That could be the very reason why someone is now going into and purchasing a new property that has been or is in the process of flip. So in other words, I guess, Michael, this is a complicated answer. It's one that you're going to see it in a very few instances. Basically, the point of this is just to make you aware that there are situations that come across when you have a buyer who is going through some sort of situation, and in fact, all of the different things that go through the transaction, they all make a case-by-case kind of situation. There's no such thing as a cookie-cutter program or a cookie-cutter transaction. Everything's got its hair on it.
So the bottom line is to get your client to the lender.
Get your client, have a good consult with your client, know what's going on, what their intention is, and then, of course, involve your lender in that so that we can be aware of anything that could possibly slow down the transaction somewhere between the date that we take application and the day you're trying to close escrow. Last thing we want to be doing is having you guys miss contingencies and miss close of escrow dates, right? We don't want it to be our problem. That's something that we caused because we were unaware of a situation that we all could have been talking about at the very beginning.
But Ed, we all like to blame the lender for that.
I'm sure my name is cursed at least daily.
I'm sure that a lot of lenders are, but that's okay. So credit issues, remedies, obviously lack of credit, add the name of an existing family member, get a Target or gas credit card, something like that. Let's talk, though, briefly about, I guess, number 2 is co-signing?
It's not co-signing.
It's not.
It's actually, if you have a young person, so let's say, for instance, that has very little credit depth. Credit depth is an issue for lending. What that basically means is that when I pull a credit report on someone, if there aren't a whole lot of accounts on there, then it's going to generate a very low score or a lower score than it could if there were a few more accounts on there, even as few as 1 or 2.
Oh.
And it's just a matter of, it goes back to the thing I said before. Credit is based upon, or I should say credit scores are based upon the most recent 24 months or so of a person's payment history. The better they've paid and the lower the balances on those accounts, the higher their score in general. So a person who doesn't have a whole lot of credit depth could very easily be added to, say, for instance, a parent as an authorized signer on a card. Not that they're ever going to get a card, but it would just basically, it transfers the good credit history of mom or dad onto the credit report of son or daughter.
Now, does that affect mom or dad's credit score?
It does not, especially if son or daughter doesn't have a credit card that's tied to that account, right? They're an authorized signer, but they're not going to have access to the funds per se. That's the way I would set it up. That's the way I've recommended people set it up. You're just adding junior onto the account to, in essence, establish a little bit of credit history for that person. It is a credit quote unquote trick. It's something that we can do that will help improve someone's credit score.
So talk to your lender if you have questions about this, or call that Jeffrey, you know. Obviously, you can get a Target or gas credit card fairly easily.
Right.
And if you can't even get one of those, you can get a secured card, which basically, you know, you put money against it and you borrow your own money. So, the credit card company has virtually no risk.
There is no risk, really. I mean, they're only going to approve the amount that you've deposited with them on a charge. But it will, again, help someone establish credit immediately. It's a guaranteed approval in almost every situation. I will knock on wood and say that there's probably one or two situations where it hasn't been approved.
Can't imagine which one would be, but okay. All right. Some remedies I think our folks would be interested in finding out. So for bad credit, what do we do?
Okay.
What's a clean account?
Establishing a clean account is basically where one that doesn't have any negative or derogatory information. So in other words, it's been paid on time.
Just pay it on time.
Right.
Pay off newer collections only.
Okay. So a collection account is similar to like a judgment or medical collection accounts. Those things typically will end up on someone's credit report for a long period of time. Sometimes to the point where you weren't even aware that it was there. We find that situation often. I found it very often with working with the athletes and entertainers who were leaving school, who, you know, the school provided them medical attention while they were there. That doesn't mean that they didn't have to sign their name and put their social security number down when they went to the doctor. They did all those different things, and those forms claim responsibility.
Right.
But if the school failed to pay them or failed to pay them
they're
on
on the
time,
hook.
They're on the hook.
Yeah.
And that's when they end up with these kinds of things that will show up, and they didn't even know that they were there. But if you pay a collection account that is more than 2 years old, again, it goes back to that 24-month period of time that I'm speaking out, what it will actually do is it will reactivate that account. It will bring a negative event of credit into the current day. It will lower your credit score.
So that's why you're saying paying off over 2-year-old collections can decrease your credit score.
Most definitely. That's why we recommend if you're going to pay those things off, pay off the ones that are only within 2 years or less. They won't hurt your score any more than just paying off a credit card or having a credit card that has a late payment on it. Similar kind of function there.
And you'll look better to the lender.
You'll look better to the lender. Exactly.
And any open account should be paid down below 50%.
Indeed.
Interesting.
So the algorithm for finding out FICO scores, I mean, you could write the numbers on all four walls around you and you still wouldn't have enough space. I mean, it's a ridiculously long equation.
But you're pretty sure of this one.
This we're almost positive of, in fact. Recommend that people basically keep their credit card balances at 50% of the balance or less. And the actual preference is anything that's below a third or right around 30%. That's going to reflect most positively in your FICO score.
Okay. Very nice. Any other things? Maxed out credit?
Yeah.
So the same thing, pay your balances down, preferably below 30%. Close excessive accounts. So pay off those accounts. You only want 4 accounts open with lower balances?
Well, 4 is a good number to have. It's obviously people have a few more credit cards than 4 in certain circumstances, but there are cards that people keep in their wallet that they don't use all that often. It could be a department store card, or it could be a card from the tire company when you went and you applied for their credit and got 10% off your tires.
Right, but you never charged again on it.
Right.
That will hurt you.
It will hurt you. The accounts go dormant, and essentially whatever payment history that you had on that account now doesn't even reflect in your FICO score.
So it's not a positive, it's actually a negative only.
It's a negative. It's a negative only. Yeah.
So close them.
Close them out. There's no reason to have them. Just get them out of there.
All righty. Let's talk about, I think a lot of people are concerned about FHA. Anything new in regards to FHA?
Well, I mean, the short answer to your question is no, not really.
Okay.
FHA hasn't changed much in a number of years. The things that are really important, I think, for present day buyers or people like yourselves, realtors that are working in the marketplace, that you be aware that people who are using FHA, the most change in FHA has been the cost of mortgage insurance. FHA has always had a mortgage insurance premium, as you know.
Yes,
Okay?
MI.
Indeed. Anytime that you put down less than 20%, you're going to end up with an MI on an FHA deal. FHA would always charge an upfront as well. Those premiums have skyrocketed in the last number of years, and the reason why they skyrocketed has to do with the meltdown, right?
Apparently people have not been paying them back, so there have been a lot of claims.
Right, there's been a lot of claims. It's just like any other kind of insurance that you buy. When you make a claim against your car insurance, guess what? Your premiums are going up, right? So a similar kind of example here with FHA. They lost a number of properties, or they had to foreclose on a number of properties. And because of that, the FHA insurance, or the mortgage insurance premium, had to kick in and pay the balances that were different to secure against the lender. In other words, they had to pay on some claims.
So, but there's nothing we can do about that, is there?
Virtually nothing that we can do.
So we just need to be aware of that. I mean, some of the benefits of FHA are, the lower down payment.
Indeed.
Generally, how low can it go?
At 3.5%.
3.5%? That's amazing.
Yeah.
And they do credit counseling,
Indeed.
even if you've gone Chapter 13?
Yeah, they'll allow for people that are in credit counseling. They'll allow for people that are in Chapter 13. They'll allow for people that have had a Chapter 7. So the FHA program is really designed for that first-time home buyer, or that person who's had some sort of a credit event. They're not as readily qualified as someone who could provide conventional financing.
And you can also have a cosigner.
Indeed, yes, indeed.
But the mortgage insurance could be quite high.
It could be quite high.
Is it a percentage of the loan?
It's a percentage of the amount that's borrowed, yes, indeed. And then those premiums, they can be financed, and the lender can pay some of those premiums as well. But in essence, when a lender pays the premium, the borrower ultimately is going to be paying for it in just a higher rate. So it's just different ways to finance these things over the period of time. Okay.
So I don't know if there's anything else here, anything that you want to talk about. FHA does not allow non-owner occupied, so you cannot do rental properties.
Right.
Can't do vacation homes, I guess. That
Right.
falls under that. You could have a higher debt ratio, so you could qualify. And what is the timetable for canceling mortgage insurance?
Okay, so this is...
And by the way, how much is that insurance? What percent?
It varies based on the amount that's down. So it could be,
okay.
In excess of 1%. It could be lower than 1%. It just depends on the situation.
But it could be substantial.
It is substantial.
And does it affect the borrower's ability to qualify?
It does, because it will affect their...
It's a catch-22,
It is
Ed.
a catch-22. It will affect their ability to... because their payment will be higher on a very low down payment, right? So they're borrowing more money. The insurance premium is higher. So their capacity, their debt-to-income ratio will be affected by that.
All right.
Yeah.
Well, catch-22.
Indeed. So you were asking about cancellation of mortgage insurance.
So you've got a timetable here.
The timetable there is incredibly important, because basically it's all determined on the way that the loan was originated. So as you can see, if a loan term is at 78% loan to value, then the required time period would be 11 years.
So you cannot cancel mortgage insurance for 11 years.
11 years.
Oh, my God.
Exactly.
That's longer than most people keep their homes.
Yes, indeed. Where I think that the ones that are really important to pay attention to are if you have a loan term that's greater than 15 years and you're putting down less than 10%, so the very bottom one, then you're going to have mortgage insurance for the term of that loan, however long you keep it.
So you might as well get used to it.
There's no way to get rid of it anymore.
Wow.
And other than to refinance the loan, which is indeed what most people are going to do. I think the important thing to be aware of here is that most people can use an FHA loan to get into a property, and then with a short period of time thereafter are more than likely going to be able to qualify for conventional financing.
So they're going to refinance it and then get out from under the mortgage insurance as well.
There are certain circumstances where a person is actually choosing to refinance with a higher interest rate. They're going to go from 3.5% to 4.5%.
And the payments would still be less.
Then payments will be less.
Amazing.
Exactly.
All right. Low down payment loans, conventional. Not your typical FHA buyer. Okay. So here you would have mortgage insurance as well.
Right.
If you put only 5% down.
Correct.
But you don't have mortgage insurance premium?
You have a mortgage insurance premium when you're putting down less than 20%, but the mortgage insurance is not written by, for instance, the FHA. It is an actual separate company. So in Walnut Creek, right on the Treat Boulevard exit, there was one of the taller buildings there was PMI.
Yes.
So they're a private mortgage insurance. So their acronym actually was appropriate for what they were going, what someone was going to be buying. But the same thing is true. There are other mortgage insurance companies that are available that are private companies that they insure these loans down to roughly 75% loan to value. So they'll take a good 20% if you're following this example, for instance, and insure that top 20% from 95 down to 75, and they're insuring the bank. So in other words, if that borrower defaults, they'll pay the 20% down. So that the bank can actually, in essence, break even or, in fact, even make money when they go to flip that house and sell it as an REO.
Well, makes sense.
Yeah.
Anything new on VA loans?
Well, VA, I'm going to tell you to defer to one of my loan officers who's an absolute expert in this, and that's Andrea Coulter. She works in the Walnut Creek and Berkeley offices. Any of my loan officers are going to be familiar with this particular type of financing, myself included.
Yeah, because it looks a little complicated.
Indeed. I can tell you, you have to love the VA. If you're really going to do these loans on a regular basis, you got to love it, because the nuances of how to do all this are somewhat complicated. But in a nutshell, I wouldn't say that there's anything new, deferring to Andrea. But in essence, this is an awesome program. And
now, how do you qualify for this?
Well, you have to be a veteran.
Okay.
All right. So,
but you have to have some sort of certificate, don't you?
There is a certificate that the veterans can get from whatever branch of government from which that they were serving, be it Army, Navy, Air Force, whatever. So there's a certificate that's issued that allows them or gives evidence of them to be able to qualify for a Veterans Administration loan. Now, the thing that people don't assume or don't know necessarily is that the VA does not issue loans. They guarantee them.
Right.
Okay. So that's really what this is about. It's about having a vet that can put as little as nothing down. I mean, truly, you can literally not have to put anything into the loan to qualify for the house. You can do 100% financing essentially. So that's a fantastic advantage for them. We do these regularly. In fact, we do a significant amount of them. We are direct with the VA. Andrea has the VA on speed dial, so she can check with various different things that are going back and forth with qualifying standards and things to that effect. She absolutely loves this. All
right. But if you've got a client with a certificate,
yep.
Get them to a lender who understands VA loans. I think I've done one in recent history, and it was fine.
Yeah, and there are a few that are out there that specialize in it.
Yeah.
So I mean, that's definitely something that you want to be aware of, and you can run those things by us. Just say, hey, look, I've got this pre-approval on this VA customer. Does this look legit? Let us be your second set of eyes, so we can say, okay, well that company may be good at them, or this one's an expert at them.
Beautiful. All right, seller credits. I know realtors are very interested in how much credit can the seller give and not knock us out of lending.
Exactly.
Anything new here or anything we should be aware of?
Nothing really new. What I would suggest is that you just be aware that these are kind of the limits. It's almost it mirrors commission numbers. 6% is a pretty easy number to remember if you're in real estate.
Okay. Yep.
You guys can do anything multiplied by 6%.
Yep.
Right? So
thanks, Ed.
So that's really what it boils down to. The higher the loan to value, so in other words, the things that are in the 90 percentiles and higher limits on the amount of credit that can be given. But typically, a 3% seller concession is a significant one.
Yes.
I mean, we don't really require all that much more than that in order to cover almost anything when it comes to closing costs.
And that's of the sales price.
Correct. Mm-hmm. Mm-hmm. So it's a very usable strategy in order to help people get qualified. I very rarely ever see seller credits when it's a non-owner occupied, which is the very bottom one there, the conventional for investment properties.
Right.
I don't know that you're going to have a whole lot of those situations come across.
No.
But just the knowledge that those are things that can be done.
All righty.
I think one thing I'll add just with that is that credits we used to have to identify the type of credit that we were giving.
Yeah, it had to be for floors or roof or something like that.
Sure.
No more?
Right. Well, I mean, there are things that I would recommend that you don't do. I wouldn't necessarily call out that you're going to use this credit for closing costs or non-recurring closing costs or recurring closing costs. That was the thing that used to trick people in my industry all the time, is that there was only certain types of credits that could be applied to certain things.
So what would you call it now?
I would be as vague as possible. This is a closing cost credit. And leaving it as simple as that is the way that I would recommend it.
Very good.
And that way we can use the money as we need to.
Beautiful. All right. Qualifying for a mortgage. I think we know most of this.
Right.
Arrive at a monthly payment that your client can afford without creating financial hardship. I know we would do that. What the lenders consider when they're qualifying you for a loan: your income, your expenses, your employment history, credit score, personal assets. I mean, those are, I think, pretty basic.
Yeah. And it's just the 5 C's.
Yep. And underwriting.
This is all lender speak. So in essence, this is where you just kind of defer back to your loan originator, your mortgage loan officer, asking them, to make sure that in fact, or just communicating back to you, quite honestly, where are we with this buyer? Can we stretch this? Do we need to worry about that? Those kinds of conversations that you're having with your lender, that's what's going to let you know where you have play in the negotiation for that home. I would want to know that, okay, so if the price is $400,000 and the borrower's debt ratio is at the max, I can't counter at $410,000. That might put them over the ability to qualify. So maybe I can counter with something else that would be of a different value, but of equal value to that seller. And it might be something weird. Who knows? You guys are the negotiators. That's the thing I love about real estate. So everything's negotiable.
Yeah, including loan rates, aren't they?
Yeah, they are.
Are they?
Well, it depends.
Depends on your qualifications.
Indeed. Well, I mean, the way I look at this is that you can choose, interest rates pretty easily. You can buy down the rate and get yourself a lower rate if you so choose, and that's by paying points. Or you could have credit issued through your transaction, and that's done by having a slightly higher rate than what the market would offer just as what is called par rate or a 0-point loan. Advertising in lending is almost designed to confuse. There are things that you can do back and forth that will help people qualify for a loan or have cash on hand at the end or whatever they're looking to do. It's really a matter of individual desire and taste. What do they want to have done? The more I know about your buyer, the more I can tailor the financing towards them.
Yeah, I think it's important, Ed, to remind our listeners that there's more than just one kind of loan. And I think a lot of clients tend to believe there's just 30-year fixed rate, one rate, that's it.
Yeah.
When this is a very personal decision that can be customized to meet their exact needs if we know what those needs are.
Yeah. When I got into finance, there were 3 loans available, 3 different products. It was the 30-year, 15-year, and the World Savings 1%. Well, it wasn't 1% at the time, but their little 1-year ARM, their neg-am product.
Right.
That was it. And obviously that's changed dramatically now. I mean, there's hundreds of programs that are available. But in general, the most important question that I've ever asked a buyer is how long they're intending to be in that home. You typically are going to get the I don't know answer. That's the first answer you're going to get. But upon digging, you'll figure out that, we've got kids, they're going to be going off to college, we're going to downsize, or whatever the situation is. He's going to retire, she's going to, get a different job, whatever the situation is. That length of time is incredibly important to know because I can tailor financing around that length of time. Typically, I recommend we build in a couple of year buffer. So if somebody says, well, we're going to be here 5 years, well, maybe you want to consider doing a 7-year or a 10-year loan. That way you have a little bit of flexibility in there. The rates aren't dramatically different on those products, but it gives someone a better interest rate for that period of time.
And it's amazing how fast those years fly by.
Oh, no kidding, right?
Some of our listeners want to know if they can get copies of your slides because they're incredibly valuable. What do you think?
Absolutely, I'm happy to.
All right. So let's do a recap of some of the things that we have been doing and talking about here. First of all, how do people reach you, Ed, if they want copies of the slides?
Okay, so they can reach out to me either by phone or by email. My phone number, this is my cell phone. I'll answer calls after 8 in the morning, and I'll listen and receive calls up until 9 o'clock at night, just so everybody knows. But basically, you call me on my cell. It's 925-594-1221.
One more time, Ed.
Okay, 925-594-1221. My email is my name. The hardest part about that is just spelling my last name. Everybody wants to pluralize it or throw an extra vowel in there or something like that. It's ed.jeffrey, which is J-E, F like Frank again, R-Y, at LHFS, which is landhomefinancialservices.com. So if you shoot me an email or text me or whatever, just identify yourself if you're texting me and it's a number that I don't know per se, and say, hey, Ed, heard you on the radio show this morning, had a question for you. I'm ready.
And if they want the slides, they can do that as well.
Indeed. You can see that this particular slideshow has been personalized to our loan officer inside of the Orinda branch. That's Angela Irves, one of our fantastic loan officers there. This particular presentation was done as a introduction to mortgage lending that we did for a group of realtors in the Walnut Creek office. Thank you for allowing us to do that, by the way. We can do that for you personally, and those of you who are listening, or for the branch management. If anyone wants to have this kind of a seminar, we're happy to do these as often as you'd like. And I think that the key to this is just understanding that there are niches of finance that are available that you probably have looked past or didn't look at all, or didn't even know that they existed. And there are ways for us to collect those folks into a room and market to them, in essence, and prove to them, hey, look, even though you've had a bankruptcy, you can buy a home. Or even though you've had a foreclosure, you can buy a home. There's really not that, there's a big stigma around those types of things. But in essence, those are folks that you could collect into a room, educate, and have them be, your next buyer. I think it's a great way to get it going.
Beautiful.
Yeah.
Well, Ed Jeffrey, I want to just appreciate you so much for being here, and thank you for all of your wisdom. I want to remind our folks that next week on Monday, September 15th, 10 a.m., we're going to be talking to Daryl Garrison from the Antioch Better Homes and Gardens office, getting more business with open houses. If you think you know it all about open houses, you don't know nothing until you've had a chance to listen to Daryl Garrison. He makes a ton of business out of open houses. He has a lot of unique ways to do it, some tips and techniques on just doing a very, very effective open house. So I hope you'll stop on by next Monday for Getting More Business with Open Houses with Daryl Garrison. This has been Michael Lee. I hope to see you again very, very soon.